Canadians are feeling house rich right now. And the question that we're going to ask today is, should you pull equity out of your home to buy even more real estate? Hey everyone, welcome back to the Vancouver Life Real Estate Podcast and YouTube channel. As we just alluded to, people right now understandably are feeling quite home rich or house rich right now. And this is obviously because we've seen prices nationally and locally exceed well into the double digits appreciation just in the last 12 months. And when you kind of look at the broader picture here, about 76% of Canadians own a home. And almost half of those are mortgage free. So much so here that like the average Canadian has 76% of their home paid off, or 76% of that home is in equity.
Wow.
Yeah, and we're talking about pretty big numbers, and understandably, people are feeling pretty stable, I think, within their position within their home. With the average price point here in Vancouver at 1.2 million, that means the average Vancouverite has about $900,000 in equity in their home.
Wow. That's a lot.
It's a lot of money. And of course, people are thinking, well, my home's doing well, but I'm seeing a lot of other opportunities of maybe places that we should consider putting this money. So whether you have 900,000, $500,000, 100,000, 25,000 in equity in your home, rather, I think there's something that we can help teach you today, or at least give you some ideas to explore.
Mm-hmm. I think we'll look at a couple things here. Primarily, we're going to look at we'll look at some REITs to give you kind of what is a REIT, how does a real estate investment trust work, what are you buying. We're also going to take a look at a group that we've done some business with and partners with in the past called Western Wealth Capital, and how you can invest dollars there and the kind of annualized returns that come out of that. And then we'll actually take looking at kind of like a legit fourplex cost to acquire that, and how we pay that off and how you can benefit from that. The other thing that I think is important to note, especially with something like a REIT, before we just get into that, is that you actually, if you're not a homeowner, and let's say you're still trying to save, or you're still trying to get into real estate, maybe you've got $10,000 and you know that's definitely not enough to buy a piece of real estate. How can you get it into real estate? How can you get it working for you in real estate? And that's where some of this will come from too. So it's not just for people who have made a ton of money in the real estate market. There's also opportunities for people who are just wanting to get in and starting to learn about how to invest in real estate. So we'll take you down both paths.
Great point. Yeah, appreciate that for sure. Yeah, this is not just for homeowners. As Ryan mentioned, there are ways to get into real estate with just straight cash and perhaps leverage your way up into a property.
Exactly.
So for those, outside of cash, talking about tapping into the equity in your home, essentially, there's a few ways of doing that. Your existing mortgage may already have what's called a line of credit on it, a secured line of credit on it, which means as you pay down your mortgage, as your equity gains, you can tap into a portion of that. Generally speaking, a line of credit or secured line of credit, the interest rate will be approximately 1% more than your interest rate. So if you are currently paying 2%, expect your line of credit in and around 3%. This is going to vary from bank to bank and lender to lender, but let's use that as kind of our example today. You can, of course, let's say if it's completely paid off, get what's called a reverse mortgage on that home. So very much like a mortgage, you're basically just getting a loan, you're taking out cash on your home, and it will be paid back accordingly. Now, to leverage the equity to its sort of maximum degree, you can also look at, and we're going to run the scenarios today, of interest-only payments, because you can borrow this money and only pay the interest. And with interest rates so low, making that spread is kind of, advised. So I don't know, maybe we put in a disclaimer right now and say, look, all investing should be done with a lot of education and with a proper advisor. We're here to kind of share some examples. I am an accredited real estate investment advisor, but again, we want to make it kind of clear that this episode is basically for information purposes only.
Correct. Yes.
So,
okay, where do you want to start, Dan?
Where do we want to start? Well, let's say the average person we're going to run 3 scenarios today. We're going to run this at $250,000 in cash, or essentially cash that's gained from equity in a property. And this money is going to be borrowed at 3%, and we're going to make interest-only payments, which for your reference comes out to about $625 per month. First example. And again, obviously you can put money into stocks, crypto, mutual funds, but as we are a real estate channel, we're going to share the 3 real estate examples today. Starting off, Ryan, why don't you walk us through option 1, which is the REIT. What does a REIT even stand for?
Yeah, so REITs are real estate investment trusts, and essentially what that means is, if you're taking that $625 a month, or call it $7,000 a year, $7,500 a year, how can I invest that in more real estate? And you can, much like you're buying a stock, you buy stock in real estate, right? So fractional ownership of real estate is really what it is. There are, a lot of these REITs are, worth hundreds of millions of dollars and sometimes billions of dollars, right? So buying fractional ownership or buying a stock is quite easy to do. You can get started for as little as, in some instances, as $150, $200, depending on whatever that share is trading for. You would do that through your bank or your investment advisor. Why I really like REITs. First of all, you don't have to have a ton of money to start buying real estate, right? So like I said, for as little as the share cost, you can start owning real estate. And what do you get out of that share? Well, you'll end up gaining passive income from the rent, right? So, and that company will either pay you a monthly or quarterly dividend based on the rental income it receives. Plus, the value of the stock will grow if the equity goes up in that property. Some of the other benefits are you get to actually own real estate without having to get a mortgage, right? Without having to sign any documents, without having to pay your taxes first, or having to worry about who you're partnering up to buy this real estate with. That's all governed for you. And you can come in and go as easily as you want. You can buy and get in and out, right? So if you look at the comparison, like I want to buy an apartment, maybe, in Vancouver here, I can't really get into that apartment for less than $100,000 or 20%. Let's say that apartment's $500,000. You're going to need a minimum 20% down to buy it. So you're looking at $100,000, right? That's a lot of money for a lot of people. And potentially some people aren't ready to pull that kind of money out of their home or take that level of risk. So that aside, you can start building more fractional ownership and in different pieces of real estate. Whether you want to get into commercial real estate too, that's an option, right? And you just have to choose the right REIT. What I also really like about REITs is that you can invest in different marketplaces across the world. So, if I'm a Canadian citizen, or let's say even conversely, I'm not a Canadian citizen, I'm an American or I'm a foreigner, and I want to buy real estate in Canada because it's doing really well, but I'm subject to the foreign buyer's tax. Well, I can avoid this by going through a REIT, right? So I can actually own real estate in different parts of the world, different kinds of real estate that I otherwise wouldn't have access to. And here's where it actually gets really interesting. If you look at, for example, I was just looking on TradingView here at the American Tower Corp, which is an American REIT. Over the last 4 years, they've had net margin gains somewhere between 16% on the low end and upwards of 28% on the high end, right? So you can actually do really, really well inside of a REIT and really protect your money too. It's a very safe place to put your money. It's backed with real estate, right? It's not backed with a corporation or anything like that, and you're getting, honestly, returns to me that are worthwhile investing in. Right. So that's what I really like. I think some of the cons maybe to a REIT is that it is fractional ownership. So your upside will be limited. You're not going to get the wild swings that you might get in a hot market by owning a piece of real estate. But again, your risk is much lower too. Right. So you're not really in control of that real estate either. Right. So you're more along for the ride. But again, if it doesn't go the way you want, you can get out quick too. So it's not like you have to test the market to sell the real estate, so on and so forth. So it's a nice option for people who maybe are a bit more on the speculative side of what's going to happen by owning or taking out a bigger piece of real estate than they'd otherwise like to.
Well said. I think too, if we want to look a little bit closer to home, look nationally in Canada, there's something like 34, 35 REITs here on the TSX. But only about 20 of those have a market cap above 1 billion, which is a place where a lot of people kind of feel like their money is a bit safer. Choice Properties is one that we've got an eye on. They basically have tenants mostly from the business of Loblaws, right? So they've got their commercial tenants there that are very consistent. And same like Smart Centers REIT. These guys largely own strip malls and outlet malls, for example. So again, long-term tenants, steady income. And these are averaging in and around 5 to 6 to 7% yield. So while that's not super exciting, it is considered stable and is obviously much better than you're going to get putting your money in, let's say, a GIC or a bond. So if we were to run our 250K cash example, that let's play on the low side. Let's play conservative with these. Yes, it sounds like the American ones, you can potentially do much better, but
they're more volatile as a result though, right? Fair. So, they will, like I said, on the low side at 16, on the high side of 28. I mean, that's quite a swing, right? So
a 16% low side is a huge win.
Yeah,
I would put money there for sure.
Yeah.
So, but again, to play conservative just on this one example here, and again, this is an exact reason why we need to talk one-on-one with someone who's considering doing this, because we're going to explore options that fit you perfectly with your time horizon, with your equity stake, etc. 250K in with your 6.5 or 6.25% yield, that's going to give you just under $16,000 a year. But don't forget, right? We've borrowed this money, that line of credit at 3% with interest only payments at about $7,500 per year. So you're going to net over $8,000 a year from this. So not too exciting, but hey, $8,000 more than you would have had otherwise is definitely money that could be used somewhere. And again, this is likely being played on the conservative side of things here.
Totally. And again, I mean, it's compounding interest too, right? So if you take that 250,000 and you grow it by 10 grand a year, something to that effect, year over year, that's going to add up, right? And it's a safe place again to put your money. It's not, the risk is low. And again, you can get out pretty quick in the event that things don't turn the right way, right? So definitely that's why it's really good.
Yeah. Having access to your money quickly is going to be important to some investors. So an example of a REIT, when you can have a 1-2 day turnaround to get that cash, is something to obviously consider before going in.
Totally. Okay. Why don't we talk about Western Wealth Capital? Because I really like this, and it's very exciting, I think, for people that don't know about it.
Yeah. So Western Wealth Capital, it's actually a local company here in Vancouver. Janet LePage created this, and their business model is quite simple and now very proven. They do a group fundraise and buy a multifamily building in growing markets. They make capital improvements to the building, upgrades, renovations, install washer dryers, put in better infrastructure, add amenities, these type of things.
Make it raise rents, all that kind of stuff.
Yeah. So they make the building more attractive first. Then they put in their own management. And that's when they, take these building or improvements, they reduce their costs, they normalize the rents, and they really are excellent at their resident retention levels. So essentially what they've done is they've bought this building that's operating at, let's say, a 5 cap, they improve it, and now it's up to a 6 or 7 cap, right? So now the valuation is much higher. They take supplemental financing along the way to help provide a bit of certainty for their investors. And then they sell. And then they sell these buildings. They do this with an average sort of turnaround time of about 3 to 5 years. And to be honest, they've done this so many times. They've owned 75 properties.
Wow.
And these are upwards of 150, 200 units per multifamily building. Of that 75, they have improved and sold 31 of them. And get this, their average annualized returns have been 30%.
Oh, over those 3 to 5 years.
Correct.
Wow. That's huge.
Yeah. They're returning an average of 74% on your equity. So if you put in 100 grand, you're getting out 174.
Wow.
within a 3 to 5 year time frame. And again, proven time and time again, which is why I think they're incredibly successful, and also why they've gone from taking months and months to raise these funds to now having a wait list because they've got more capital coming at them than properties that they own.
So if we just take a quick snapshot of our 250K scenario, right?
Mm-hmm. Yeah.
So 250K, we've taken that out of my home. I'm now borrowing that at 3%, right? So it's costing me $7,500 a year, right? So over the course of, let's say, 4 years, that'll be about 30 grand, right? So I've got 250K in, I'm getting 30% a year. That's actually $435,000 or $185,000 in profit over those 4 years on my initial investment, less the $30,000 it cost me to borrow. So I'm netting 155 grand or $38,000 a year. That's incredible.
That's when the numbers start to get exciting.
How do I give her my money?
Yeah, and honestly, similar to your REITs, you can obviously buy these with just cash. It's about 25,000 US minimum to start, and you can of course increase your equity stake, but that's kind of your minimum to get into this. And yes, we are saying, we're giving you net numbers, but of course this is pre-taxes because this will have capital gains applied. But again, that's why you need to contact us so we can talk about your specific scenario. Are you investing through a corp, personally, joint venture? There's all sorts of different ways that these can be taxed. So make sure you understand the taxation first. But at the end of the day, a 30% annualized return is, it's very enticing.
Yeah. I mean, just before now we move on to our next one, our fourplex scenario, just a reminder that if you haven't yet already hit the bell, please hit the bell. And if you haven't hit the bell, make sure you subscribe because this is good information. And if you're looking to invest, we have, avenues to get you into these. So anyhow, let's move on.
Oh, wait. Before we do, just a couple more things I think I wanted to touch on with Western Wealth. Some of the pros here, definitely, you are seeing a really nice higher yield than a lot of investment options. It's totally hands off. You give them your money, you sit back and you wait for your returns. And yes, they do pay quarterly dividends as well. So you get your dividends and then you get your, basically your big payout once they've sold the building. And of course, like I said, that proven track record is quite undeniable. But do recognize, there's going to be downsides to any investment and definitely recognize that you could lose everything. So be prepared for that. But for this strategy, definitely recognize that money is essentially tied up, right? You can't go and just sell your stake in this because they hold that money, they use that money for the duration of the project, which again is around 3 to 5 years. So, you don't want to stretch yourself thin and not be able to have that rainy day fund because you won't be able to access these funds in case of an emergency. And
so don't take out all the equity in your home.
Right. Yeah, exactly. And like I said, last time I checked, there's a wait list to get in here. So, you may not even get in the next 1 or 2 projects that are available. But again, long-term, it is something worth looking at.
Get on the list.
Yeah, get on the list. Okay. So third option. We've talked about 2 very sort of hands-off, other people manage your money, other people manage the real estate. The third option is, of course, buying your own real estate, an investment property, and putting in tenants. Lots of different ways to do this. The one we're going to explore today is an off-market listing. This is a true listing that exists. It's in Nanaimo, an area that we are very bullish on. And it is a fully tenanted fourplex. Built in 1992. The top suites have a bit of partial ocean views there. 4 separate titles. And this one actually has zoning for a carriage house. So you could add some equity there. We'll try to keep it a bit simple, but asking price on this fourplex is about $1,050,000. So, without getting too into the numbers here, with your down payment, property transfer tax, legal fees, inspection, so on and so forth, you can purchase this fourplex today for about $240,000 in cash.
Right.
It's got its expenses, of course, as anything would. This includes, it's got some maintenance fees, obviously insurance. Again, fully managed, right? You're not going to manage it. We're here in Vancouver. This property's in Nanaimo. You don't want to be heading over there to change a light bulb. So you've got management in place, property tax, utilities, and so forth. So at the end of the day, with a 80% loan to value mortgage and all your expenses, with the tenants that are in place today, this property will still cash flow about $240 per month.
Huh? Nice.
Something, right? So there's your dividends. So you are getting some
Yep.
cash from this, right? You're getting about
Yep.
$3,000 a year. But of course, a big play here is the appreciation and the mortgage pay down.
And the control.
And the control, exactly. That's a huge pro.
Yeah.
We have run 1 year and 3 to 5 year scenarios. So for this one, for example, let's run a 10-year. If you hold this property for 10 years, the target sale price is going to be, sorry, let me pull this up, about $780,000. Sorry, so we bought that for less. There's 1.4 million is the.
Yes, that sounds more like it.
Yeah. Sorry, got to read the right line item here. $1.411 million after 10 years. So it's gone up about $400,000 ish. You sell it, there's selling costs. There's a net profit there at around $580,000.
Wow.
Now we've borrowed that's $7,500 a year. So there was $75,000 total that you've been paying in those interests. So back that off, you're still sitting at about $500,000 net yield on this one.
Yeah, or $50,000 a year.
Right. Yeah, $50,000 a year.
I mean, that $50,000 a year is not cash; it's equity, right? So that would be like your stock value in a REIT going up, right? Mm-hmm. And you wouldn't see that unless you sold. Right. But again, it's in line with kind of how the other assets perform. You're looking at roughly 24% return on investment that's annualized, right? Like Dan said, the big key here, I think, to me anyways, is that you have full control. So if you don't like your rents or something like that, you can actively work to make this a better investment. At the same time, though, I personally own with actually four other guys, we own some fourplexes. And so I know firsthand what it's like to manage these products in a different province. It's difficult. It's very difficult without management, right? And it can be stressful because what happens in BC might not happen in Alberta. What happens in Alberta might not happen in the GTA, and so on and so forth, right? So if you are remote, you'll definitely want management on the ground helping you with these things, because otherwise it'll become a very stressful investment if you're not used to it. Right?
Exactly. Generally higher risk, higher reward. This one does have upside potential. I think, like we mentioned earlier, meaning like Ryan said, you can improve the building itself. You can maybe hire better management, normalize rents, and maybe even build a carriage house at some point. Like there's a lot of upside here. But again, you're going to be a little bit more hands-on on this one. Potentially, right? Yes, you've got management in place. Yes, it already comes fully tenanted. I certainly own properties that are in other provinces that I've actually never seen. They've been managed brilliantly, and you just check your bank account every month, so they can be fairly hands-off as well. But essentially, there you have it. Those are 3 sort of top-level examples of how you can make money off the equity in your home. These vary from about 6 to 25, 24 to 30% annualized returns. So obviously something that if you are feeling like you want to invest some money or tap into the equity in your home, we'd be so happy to talk to you further one-on-one about these options and what, of course, fits your financial goals.
Cool. I think you kind of wrap that up nicely. I don't really know what else I'm going to add to that.
Okay, perfect. Well, hey, thanks as always for listening. If you're getting value out of this, please subscribe. Please tell your friends. We bring you this kind of content every single week, and we're happy to help you guys invest some of your hard-earned equity.
Okay, guys, we'll see you next week.